It's down right now. It's 161 today.
And where was it yesterday?
162.
Okay, so it's down how many basis points? Zareen, how many basis points? What? 1 basis point, got it. Got it. So interest rates went down, right? What's the Fisher equation? The Fisher equation is a guide to nominal interest rates. So if the 10-year Treasury yield went down, test question, if the 10-year Treasury yield went down, what did the 10-year Treasury bond prices do? If the 10-year Treasury yield went down, then the 10-year Treasury bond price went, come on.
Bond prices went up.
Went up, got it. Interest rates go down, bond prices go up. Interest rates go up, bond prices go down. Yields went down, bond prices went up. Why did the yields on the 10-year Treasury go down using the Fisher equation? And I'll write some of the stuff on the board and stuff like that at some point, but I'm just trying to get you guys to start thinking about all your finance classes, your econ classes that you took, to try to resuscitate some of that latent memory so that I can get you to start thinking on my terms, to start thinking at my level. So using the Fisher equation, what's the two variables that determine nominal interest rates?
Inflation and real interest rate.
The what?
Inflation and the real interest rate.
The real interest rate and inflation. Inflation expectations, got it, okay. So the yields on the 10-year Treasury went down. What did the real rate may have done? So using the Fisher equation, if the 10-year Treasury yield went down, what could the real rate have done?
Gone up.
How's that work?
Because the numerator.
It doesn't, there is no numerator, it's a linear function.
So the inflation expectation?
So the Fisher equation's what? Again, that's a question, because I only heard 2 people get it right. So the Fisher equation's what?
Inflation expectation?
No, it's the what?
Inflation expectation.
Well, the inflation expectations is not the interest rate. There's 2 factors in the Fisher equation.
The real interest rate and the inflation expectation.
Perfect, thank you very much. So if interest rates went down, what could have the real rate done?
Gone up.
How's that work?
Going down.
You want to do the mathematics and prove it on the board? Okay, we'll do it again. It's like shooting ducks. Got it, equals real rate plus, just use my terminology and my notation, inflation expectation. So if the real rate, if interest rates went down, got it, does that make sense? How's that work mathematically, arithmetically? This one would have to go down, right? Because it's a direct relationship. Okay, so the real rate could have gone down, so you got to look at that. But if you hold the real rate constant, what caused interest rates to go down?
Inflation expectation.
Inflation expectations, got it. Now, inflation is also a reflective of what?
Changes in the market or changes in the future.
No, but what does it measure? What does inflation measure? What are you measuring?
Supply of dollar.
Inflation measures what? What are you measuring? When inflation expectations go up and down, what are you expecting?
Yes.
No, what does it measure? What does inflation measure?
The value of the dollar.
No,
Is it the amount of money in the market?
no. What is it? What is it? What is the CPI? Bureau of Labor Statistics, the CPI, Consumer Price Index, what does it measure? It's a measure of inflation. What is it measuring?
Price level.
What?
Price level.
Exactly, it's measuring price levels. So if inflation expectations are falling, what's the expectations of prices? They're going to go down, okay? And what does that tell you about future expectations of economic growth? It's going down. So the expectations of future GDP growth rates, the future expectations of economic growth have been revised down, reflected in the revision in prices. Got it. So falling interest rates could mean that the market expects what? Falling prices, which would also mean slowing economic growth. And if this falls significantly, what does it tell you about the future state of the economy? Recession. Got it. Got it. So the inflation expectations, the interest rates, not only measure supply and demand for bonds, right, because there's high demand, right? High demand for bonds, bond prices go up, interest rates go down. Got it. Why are people going into bonds? Because they're scared of stocks, and they're moving out of stocks into bonds for liquidity and safety. Got it. Why are they moving out of stocks into bonds? Because they think the prices are going to go down due to a slowing economy. So they buy bonds and drive interest rates down because they're scared. They want liquidity and they want the safety that the bonds provide because the stock market is very risky. Is the stock market overvalued or undervalued today? Is the stock market over or undervalued today? It's probably over. You want to look at the chart? You want to look at the S&P 500? It's off the chart, okay? It's off the chart. We're in an asset price bubble driven by over-accommodated monetary policy.
What do you think about CDOs?
It's a structure of a type of financial instrument that basically was used to short the housing market during the financial crisis. It's just a product.
Are they still being used?
I think so. Okay, let's do dollar to the pound, dollar to the euro, dollar to the pound. So how much does it cost you to buy a pound today? $1.35?
$1.30.
$1.30, where was it yesterday? $1.29, does it cost me more or less? What? Cost me more. If it cost me more, did the dollar appreciate or depreciate? Depreciated. Did the pound appreciate or depreciate? Got it. Okay. Where's the dollar to the euro? Usually they're correlated. But, you know, Brexit has added a different dimension to the exchange rate. 1.08. 1.08? And today? Yeah. Oh, it's down? From what?
It was at 1 point, yeah.
What?
0.28%.
What?
0.28%. 0.3%.
No, flip it.
It was less than a cent, pretty much.
Yeah. Oh, okay.
So
So-
it's not that big of a difference.
So did it go up or down?
It went down.
It went down, so basically it's cheaper to buy the euro now?
Yeah.
So did the dollar appreciate or depreciate against the euro? Got it. And the euro to the dollar? Depreciated, got it. Okay. So that's just kind of the exercises, you know. As we go on, it'll get easier and easier, but you gotta start tracking the markets, okay? And then I'll just grind into you, basically the microeconomics around these asset classes. So it becomes real, as you start to read and hear about the markets, you'll hear about the factors, both geopolitical, economic, factors that are driving these asset classes up and down. Okay, so that's basically the first. Did you pull up the course website? Do I have the right one up there? Yep. All right, are you guys got it? Got it? Okay, good. All right, so here's the logs, right? And what I'll do is I'll start posting, these videos as we do the lectures in the class. And then, so you'll have the logs, but there's some logs here from last semester. There's a bunch here, if you're interested in kind of looking at what we did last semester. I had set this up, I'm gonna go talk to these guys. The Chicago Mercantile Exchange set up on our behalf basically a derivative trading platform so that you could trade futures and options on futures contracts in a $1 million environment. So you could start trading currency options and futures and stuff like that to kind of test, and play with the trading around these things. I haven't implemented that in my class, I wish I had more time to be able to do it, because I think it would be pretty interesting. I did have, at one point, a company that I worked with called Equity Sim, which gave you $1 million and you traded basically a basket of your 25 stocks that you picked for your portfolio. You were trading them in this account, and it basically tested to see how you did based off of either finance theory or economic theory or technical trading analysis, what your rationale was and how you placed your trades. And then what they would do is they would evaluate your trades and your performance. And then if you did really well, they would get you interviews at the top investment banks and the top brokerage houses for interviews and internships. And then after about a year or two using the system, they came back to me and said, we want to charge your students $100 each, you know, to be able to trade this thing. And I said, screw you, I'm not doing it. I want it for free. And I found this one. But there's NASDAQ has it, there's some others. If you want to trade more of the account, in an account, to do some day trading and test that up, you can set that up and do that if you want to do that. I highly recommend it. So I tried that with that. And then here, what's this? Aries, renewable energy. So this is just an old PowerPoint presentation that I put together on the energy sector. This is an investments class, right? Well, the book basically doesn't really go into much depth in alternative asset classes. Energy, right? Nothing really on energy. There's no renewable energy in here, which is a hot sector. There's no discussion on real estate. There's no variable annuities or insurance product discussions in here. So this is a traditional corporate finance that doesn't really discuss, you know, emerging markets such as alternative assets is an emerging, you know, sector of the investment universe. And so there's a huge gap. So if anybody's interested, I do have that energy presentation. Did we break up into groups? No. Okay, do it. Groups of 3. Go. Quickly. Groups of 3. Okay, quickly. It shouldn't take very long. 3. Go. You got one? Okay, good. Okay, and then once you've got your team, raise your hand. Are you guys done? Okay, you're chapter 1. Team 1, chapter 1. Got it. Next. You guys are ready? Okay, team 2, chapter 2. Team 2, chapter 2. Keep going. Team 3, chapter 3. Team 4, chapter 4. Okay. Got it? Team 5, chapter 5. Who else? Okay. So you guys? Team 6, chapter 6. Okay, awesome. Who else? Okay, who doesn't have a team? Okay, you got to get into a team, man. You get up, you walk around, and you say, "Hey, are you in a team?" So who's not in a team? Okay, you, and you're not in a team. Oh, awesome, perfect. What you need? Okay, where were you? 6 chapter, team 7, chapter 7. Okay, who's not in a team? Raise your hand. Straight and high. Straight and high. Hey, you guys are team 8. You're team 8, chapter 8. For now. You can work with other teams. You can work with other teams, but you're going to be a sub-team. Okay? All right. All right, so we got the teams. We got the chapter allocations. Okay? Start reading the chapters. The PowerPoint presentations are up there. Edit down the PowerPoint presentations. Be ready to do a 15-minute presentation on the chapter. Got it. What group are you? What? Okay. Oh, 8. You guys are 7, right? Okay, then you're 9. Chapter 9.
Is it the technical analysis chapters?
Yeah, let me go through this first. Okay. All right, everybody ready? Everybody like who their team? This class is going to move really quick. Okay. You can cruise in your other classes, but, you know, this is dynamic here. Okay? It's like a job. Okay? We're gonna have fun. Okay, so let's do it. Okay, so now you need to pick and then introduce your team. You need to pick who your portfolio manager is, who your technical securities analyst is, and who your fundamental securities analyst is. Go.
What's the name of the technical securities analyst?
Over the three titles?
Portfolio manager, technical security analyst, and fundamental securities analyst. So let's audit the teams. Team one, audit the team. Okay, I'm auditing the teams. Team one, I'm auditing the teams. Team one, got it. Team two, team three, team four, team five, team six, team seven, team eight, team nine. Perfect. Okay, awesome. I'll work with you guys, or we'll do it together. Okay. Okay. Now we got the teams. Now we got the chapters assigned. Awesome. Okay. Now let's go through this part. Have you guys come up with who the portfolio manager is, the technical securities analyst, and the fundamental securities analyst? So team one, once you come up, will you stand up and introduce your team? Okay, come on, hurry up. Storming, forming, norming. You know, it's Marine Corps, U.S. Marine Corps. Let's get it done. Come on, man, get in the trenches. Get it done. Okay, everybody got team one? Introduce your team. Come on, you guys. You get up and you introduce your team. I'm not going to wait around as you guys negotiate and dilly-dally.
I'm the portfolio manager.
What's your name, and then introduce yourself.
Stefano, I'm the technical security analyst.
Perfect.
I'm Spencer, I'm the fundamental security analyst.
I love it. Perfect. Team two.
I'm Kevin, I'm the securities analyst.
Technical or fundamental?
Technical.
Got it. Okay.
Jackson, I'm the technical security analyst.
No.
Technical security analyst.
Perfect.
I'm Evan Stratford, I'm the portfolio manager.
Perfect. Team three.
My name's Albert. I am the technical security
Analyst.
I'm Richie Grimes and I'm the portfolio manager.
Nice.
I'm Utah. I'm the fundamental security analyst.
Okay, cool. So number four.
I'm Jose, I'm the technical security analyst. I'm Logan, I'm the fundamental security analyst. I'm Holbert, I'm the portfolio manager.
Perfect. Five.
I'm Noah, I am the portfolio manager.
I'm Samantha, I'm the fundamental security analyst, and Eleanor is our technical security analyst.
Great. Perfect. Number six.
I'm Trevor, I'm the fundamental securities analyst.
I'm Jack, I'm the technical security analyst.
Aaron, and I'm the portfolio manager.
Great. Eight. Or did I skip seven? Okay, go seven. Sorry about that.
I'm Serene, I'm the technical security analyst.
I'm Nick, I'm the fundamental securities analyst.
I'm JC, I'm a portfolio manager.
Nice. Okay, eight.
I'm Kian, I'm the portfolio manager and the technical securities analyst.
I'm Derek, I'm the fundamental security analyst.
Nice. And then nine.
I'm Eric, I'm the portfolio manager.
I'm Kayla, I'm the technical securities analyst, and Jasmine is the fundamental security.
Okay, perfect. Awesome. Okay, so let's go through it. So the technical securities analyst, here's the technical documentation. Okay, I basically went through about a half a dozen of my technical securities analyst reports, because I don't think that the book does a very good job on technical securities analysis. And I know that some of my colleagues don't believe in it, which I think is crazy, because a lot of the major banks and brokerage firms and hedge funds and trading firms all use technical securities analysis to trade stocks. So, plus I went to Golden Gate University, which has one of the top certification programs and concentrations in technical securities analysis. Next to the Financial Securities Analyst Institute out of New York City. So it's one of the top two. So what I did was I went through all the books and I pulled out all of the technical securities, the chapters that I thought that were the most. So you technical security analysts, you should work your way through that, okay? Because it's really important. The book does a really lousy job on technical securities analysis. I'll train you in it too. But you guys need to be specialized and really focus on that area. You'll get a lot out of this because I'm training you how to be a trader. And then I also have on the website the SIE exam. For those who want to get the SIE exam, do this, buy it, study, take it, get it done, and then you'll have your ticket in hand when you walk into these companies. The SIE is awesome.
Is that a report that is that a test we take at the end of the semester or at any time?
No, you can. This is not required. Accident insurance or accident advisors, I negotiated with them. They came to the college. They said what we'll do is we will provide the licensing, the securities licensing for the SIE, which is the first underneath the Series 7, which is what everybody needs. If they do this, we will hire them as an intern, as an advisor. If they want it, you can go anywhere. You can go to a bank, hedge fund, private equity, whatever. It basically just says about the economics, about the finance, the securities, the trading, types of trades, and the regulations, okay? So it's pretty cool, $116 plus tax, okay? And then actually what I'm gonna do is I talked to one of the people from Securities Training Corporation, and I'll set up a time where we'll do a Zoom call, and she'll walk us through the SIE so that you guys can get familiarity of how you take these standardized tests. Because you may want to sell insurance, well, you got to take the state of California insurance license. You want to sell securities, become an investment advisor, you got to take the SIE, Series 7, Chapter 66. You got to take the variable annuity, continuing education. You might have to do long-term care. So you have to take these securities licenses to be able to broker and sell and advise, under a broker-dealer. Yes, sir.
How long does it last?
An hour 45.
What is it?
An hour 45.
It is?
Yeah, or I just.
The SIE, is that what it is?
Yeah.
So it's not that, it's not that
Only
long.
75 questions.
Yeah, it's pretty straightforward. Sam Carlson took it, studied for like a month, and then took it and passed. And I do have his notes too on what questions were actually asked on the exam. So I can provide those to you, and then I'll do the Zoom stuff. So you can get kind of a feel for, what's going on over there in the securities industry, okay? I'm kind of jumping around a little bit. And then I already gave you the take-home exam, right? There you go. Oh, and there's the midterm exam, also too. And what happens is that the take-home exam, like I told you before, is a lot of writing, and then the midterm gets a little easier, it's more reading, and then filling it out, and then the finals, super easy, it's just reading with a little stuff. I just want you to read all the content, in the book. Here is, I also have another midterm exam. In the midterm exam, it was really interesting last semester. I had Taylor in my class. Do you remember Taylor? Mauler or Naylor? Yeah. He was like amazing. He got like all of the groups in the class. I thought this was incredible because we had this midterm exam. That was, the questions. And then I did the presentation on my doctoral defense so that you can get an idea of how I designed, you know, modern and postmodern real estate portfolio theory, modeled after modern portfolio theory based on Markowitz. So how I came up, you know, with the dissertation topic, all of the research that I did, using it for my doctoral defense, and then what were the conclusions? What was the, you know, how do you use what you're learning in finance? How do you actually apply it to build multi-billion-dollar portfolios of, you know, stocks, bonds, whatever they are? I was doing real estate. So the doctoral dissertation was basically a manual on how to build, evaluate, build, manage, and hedge multi-billion-dollar portfolios of real estate. Okay, so I just took everything that was done, you know, from the book, and then basically applied it to real estate and made a dissertation out of it. And then I presented a defense, and I have a bunch of questions, and Taylor was brilliant. He basically, you know, doled out the questions to different groups. They all came in, they wrote up the questions on the board, and they basically all took pictures, and basically boom, was done with the midterm. Thought it was freaking brilliant. Right? It's easier when you work in teams, right? Yeah. And then I think I also have a videotape too. Okay, so that's one of the midterms. Here's some course logs. There's the final exam, bam. Here's the syllabus. Here's the statistical pre-test with the resources right here. And actually the Bodie and Marcus book has a useful formula section at the back of the book that has a lot of the formulas that are in the pre-test. Okay? And the book also, you're gonna have to pull it out, has that question in the pre-test that asks for the portfolio standard deviation calculation with the one scenario with the covariance on the end and the other scenario with the correlation on the end. Both of them are actually in here. You're gonna have to take them out. But I want you to look at those. And then here's our spreadsheets. So what I would do is I would download this folder, okay? Because these are all this is the Excel material that we're gonna use in class, okay? So I'll walk you through it right now, okay? I'll pull them up right now. And I'll walk you through them once, I'll walk you through them again, and then what you're gonna do is, like here, the stock portfolio, you know, the portfolio manager will be in charge of these, right? The intrinsic valuation calculator, that's going to be the fundamental securities analyst. The investment profit loss statement is going to be the technical securities analyst, and I'll walk you through that too. This is an updated version of that. And then some summary financial ratios and valuations, which is also part of the exercise. And again, I have, you know, here are just a few. I'll bring some more of the final report so you can see how all this stuff is rolled up into the, you know, the portfolio trading system that you guys are going to develop. So why don't we pull up the first passive stock investment spreadsheet. And I'll show you how I program this thing. It's a very simple backtest model. It's not rocket science. I don't have, you know, dollar cost averaging or rebalancing done on a quarterly basis in this thing. I just, you know, I could only do so much, you know, in the amount of time that I had to develop it, but it does a good job of back testing your portfolio. Both the static portfolio, the active portfolio, the target portfolio, which are the three scenarios and the three types of portfolios that you're going to develop and then sell, you know, in the marketplace. Do you guys got that up? Are you bringing it up so you can see it? Now, my recommendation is to designate an individual. This is my recommendation. I would designate an individual to be the master of the file, okay? And use Microsoft 365, okay? Don't use Google Sheets and stuff like that. And don't share the sheets because they could get corrupted or they could get messed up, okay? So you gotta be really careful, particularly the optimization piece. I've had multiple semesters where people are sharing it or they're doing something to it and it blows up and they gotta go back and redo it, everything over again. So you gotta be like super careful. What's the first thing that you do when somebody, do you think somebody's gonna give you an Excel spreadsheet? When you go into a job, do you think somebody's gonna give you an Excel spreadsheet to work in, a template? Hold on. In a lot of cases, do you think that they're gonna give you an Excel spreadsheet as a template to use? In most cases, are they gonna give you an Excel spreadsheet, a template for you to use?
No.
Test question. Don't you think when you walk into a firm that they're gonna have standards and templates that have already been developed before you walked in? Unless they hired you to build all that stuff, which would really suck, right? Because it takes hours and hours and hours to build these things. They may have you modify one, but they're probably gonna give you a template and tell you to modify it or extend it or expand it or do something to get it to try to solve whatever it is you're trying to analyze. So in most cases, you're gonna get a standardized Excel spreadsheet to use. Got it. What's the first thing you do? Here, Reggie, here's the Excel spreadsheet to do the, the back testing for the passive securities portfolio. Well, I already gave it to you. What are you gonna do? What's the first thing you're gonna do when you open it up? What are you gonna do? You're gonna read it, but what else are you gonna do? Okay, but I would do something first.
Put your name on it.
I would do something first.
Ask them what it's due.
What?
Ask them what it's
No. No, what are you gonna do? I just gave you the spreadsheet. How many worksheets are there? A lot. What are you gonna do?
due. Organize it.
It's already organized.
Look through all of them.
What?
Look through all of them.
Yeah, and what are you specifically gonna look at? Yeah, but what are you gonna look at? I'm testing you.
That's the instruction.
You're gonna read the instructions, but what are you gonna look at in detail? What are you gonna check?
The numbers are right.
Yep. You're gonna check the formulas. Make sure they're pulling correctly. Do you think people ever give you a spreadsheet that's has errors in it?
Yeah.
Yeah, and you're gonna do the analysis with errors in it. And then when you make the recommendation and it's flawed and actually you end up making a mistake, who are they gonna blame? Yep. Are they gonna blame the other guy that gave it to you? No, because you should have checked everything. Make sure it's correct. Okay, it's just that I'm giving you a heads up. Okay. I'm not saying that I'm perfect and I don't make mistakes all the time. I do make mistakes all the time. But again, I try not to make mistakes. And hopefully I have people that I work with that help me work together to make sure we don't make any mistakes. So the first thing you do is you audit the spreadsheet and understand how it's all linked together and how it actually works. So the spreadsheet, look at that, I got instructions down here. I got instructions here, okay? And then I have the master target portfolio right here. Okay. I'm gonna zoom out a little bit. Got it. Okay, so this is the first one. All right, so is this thing pulling from anywhere? No, it's not pulling. So it's a master template. There's probably other spreadsheets are pulling from this one. So the first thing we did was we figured out our portfolio strategy. So we kind of figured out what sectors, we wanted to figure out what were the sector allocations and what was our our portfolio strategy. And here are the weights that we came up with. Right here. And they add up to 100, obviously. So either we can come up with the sector weights or we let it kind of fall out based on the companies that we pick. But you got to have a sector, because based on the sector allocations is going to determine what the return and what the risk is going to be on the portfolio. Okay, and who you're going to sell it to. This was done February 11th. Got it. So we picked the stocks: Apple, Salesforce, Amazon, London. That's the first sector. Raytheon, Northrop, there's your defense. Then here's our healthcare exposure. Then here's our consumer goods. Then Netflix and Starbucks. And then we had some financial services firms here. So 1 to 25, and then we grouped them by sector. Then we put in the, North American Industrial Classification Codes, the NICS codes. So we know what industries they are. Then we have their ticker symbols, okay? And then we put in the stock price as of January 1st, okay? And then this forward test, the first test over here, this would be, where are we now, in February? We put in the numbers as of February, look at the returns and compare it against the S&P 500 return, as of February. So we could do that. But let me walk you through this. So here, we got the firms, then this is the stock price, okay? Then, what we did over here in blue is we put in their market capitalization. So how do you calculate the market cap? What's market cap? What's market capitalization?
Isn't it share price times outstanding shares?
Exactly. Yeah. So you can use the market cap of the equity, or you can use the total market cap. And what's the total market cap? How do you calculate total market cap? How do you finance a company? A publicly traded company. How is it financed? How do they finance the assets?
Equity plus stockholder.
No, and when you're financing it,
IPO?
no, on the balance sheet.
Oh.
You issue stocks,
Liabilities, debt and stuff.
debt, got it. Okay, so you can calculate the market value of the equity and the market value of the debt to get the total market cap for the company. So you can use that too. Can I put assets in here? These are basically scaling factors, okay? This is a beta approach. This is like creating an exchange traded fund, and I'm using the value of the assets, either book or market. I'm using the book or market value of the equity, or the book or market value of the debt and the equity. So I'm just using it as a weighting factor, okay? So you pump in basically the factors, and then what we did, the problem was Apple and Alphabet and Amazon were such huge companies compared to the peers that their concentration is like a few stocks were getting the majority of the concentration, the allocation in the portfolio. And I said, I don't want to have 25% or 20% of my stock portfolio being exposed to Apple. What I want to do, what I'll do is I'll bring down, I'll just adjust down the market cap for Apple. It'll redistribute across the other shares. And what I'll do is I'll play with these weighting factors to create maximums and minimums. And the portfolio manager said, I don't want to have more than 10 or 12% of any one stock having more than 10 or 12% of the total weight within the portfolio. And I want to make sure that no stock has less than 2%, in the portfolio. Because it's zero, it's like, why am I even investing in it? So I got to have some kind of exposure. So you start with the price, then you start with the scaling factor. What it does is it adds it up, divides it back, and here's your weights. Okay? Then what it does is it multiplies the weight by the $1 million that you invested in the stock, which gives you the total value that you need to invest in the stock. The total value divided by the share price gives you the number of shares. Okay? And that becomes the static. We should, rebalance every quarter and do all kinds of stuff to it. But I said, nope, let's just figure it out and then use those number of shares over time, keep those constant, and see how the portfolio performs over time. So what we did was we went back to, we did the 1 year back test. January 1st. This will be January 1st, 2000. This will be January 1st, 2019. Got it. Okay. Now the number of shares aren't going to change. Okay. But the share price will change. Okay. The share price times the number of shares is gonna give you the aggregate value. So what we did is the value of the, so if we bought these numbers of shares last year, we would have paid basically $800,000 for it. And then we started at $1 million, right? So basically, if we bought these number of shares a year ago, as of today, we would have gotten a 25.1% rate of return. Huh? And then what we did was we calculated the year change in the S&P 500, which was 18.3, subtracted from our return on the portfolio, the return on the market, to get the alpha. Now, at that rate of return under the rule of 72, we're going to double our money in less than 5 years. 72 divided by 25, it's less than 5 years. Okay. So you take that, is that good? Yeah, that's pretty good. But what happened over the last year, I mean, so 1 year performance is not an indicator of the long-term performance of the portfolio. So we got to go back further. So what we did was we went back 3 years. So we went back 3 years. And if we would have bought these number of shares 3 years ago, we would have paid $624,000. $1 million, we would have gotten 17% average annual compound growth. Average annual compound growth. And I'll show you how to calculate it, but you can calculate that if you click on this thing. So there's your formula. Up there, so F32, F32 divided by F31 raised to the 1/3, 3 years, minus 1, and then I formatted it so it came out to be a percentage. So 17% average annual compound growth. Is that pretty good? Yeah, that's almost 20%, which means under the rule of 72, you're going to double your money in a little over 5 years. Okay. Would you be happy as an investor? Yeah. So we get diversification, but we're also getting pretty good returns. And we were generated over the S&P 500. We had to calculate the average annual compound growth rate on the index. Subtract it, there's our alpha. So these are very attractive alphas. Okay, so this portfolio, the composition of the firms and the sectors that they selected actually did really good performance. I've only had like one group out of literally 100 or 200 students pick underperforming stocks. Where the calculations didn't work. Their rates of return were below the benchmark. But would you buy a portfolio that yields 8 or 10%?
Can you say that again?
Yeah. In some of my classes, looking at all the pools of students that I have, I've only had maybe a half a dozen of the hundreds that have actually picked stocks and the sector allocations where it underperformed the S&P 500. So the question for me, to them was, did you want to go back and try to find better stocks, or do you want to try to sell the portfolio's underperformance based on a couple characteristics? So my question was, do you care if the portfolio underperforms if you're getting an 8 to 10% rate of return, but the portfolio that you constructed is significantly less risky than the market? Yeah, exactly. If the market's doing 12 and we're doing 10, how long does it take to double our money under the rule of 72? 7.2 years, got it. Most investors are happy with that. Most investors are happy with an 8% rate of return. 10% is even better. So if I can get my expected rate of return, I'm going to double my money in my pension fund. I'm going to double my money in 10 years. I got a 40-year life. 10 years is only 1/4 right of my investment horizon. But my beta, the beta calculation on my portfolio is 0.6, right? If my portfolio return moves exactly with the market, what's my beta? If my returns on my portfolio move exactly with the market, what's my beta? If the return on my portfolio moves exactly with the market, what's my beta? 1. Got it. Got it. So if I'm getting a beta of 0.6 and I'm giving my client an 8 to 10% rate of return, do I have relatively high risk-adjusted rates of return? If I take the return and I divide it by the standard deviation, or if I take the return and divide it by the beta, am I getting higher risk-adjusted rate of returns? I'm at 10, my beta is 1, right? So what's my risk-adjusted rate of return? 10. Got it. But what if I'm getting 20% rate of return and my beta is 40? What's my risk-adjusted rate of return? It's like 0.5, right? Yeah, 10 divided by. So the question is, are you willing to take a lower rate of return for significantly less risk and still increase the risk-adjusted rate of return? The answer is yes. I can give my client a 20% rate of return, but if my standard deviation is 40, I'm getting a 0.5 unit of return per unit of risk. If I can give my client a 10% rate of return and my standard deviation is 5%, then I'm getting 2 units of return per unit of risk. I'm getting less return, but I'm getting more units of return per unit of risk. Okay? Let me do it again. 20% return with a standard deviation of 40%. I'm getting 0.5 units of return per unit of risk. I got a 10% rate of return over here on portfolio 2, but the standard deviation is only 5%. So I'm getting 2 units of return per unit of risk. Some investors would say, I would rather have portfolio A. I'll take the 10% because I can double my money in 7.2 years. And I've significantly reduced the risk from 40% to 5%. I'd rather take the 10 at 5 than the 20 at 40. Okay? All right? All right. So here's the alpha on the 3-year. Okay. Let's look at the 5-year. When I'm evaluating stock portfolios from other, Loring Ward and some of the other firms that I'm looking at the 1 year. I'm looking at the 5-year, or the 3-year. I'm looking at the 5-year, and I'm looking at the 10-year. Okay? Now the problem is, and here's the 5-year. So 5-year average annual compound growth rate is 19.3, the market is 12.8. I got 653 basis points of alpha. It's still off the charts.
Quick question.
Yeah.
Does that include dividends?
No. I didn't do dividend reinvestment. I just made it a really simple model so that you are learning how to construct these portfolios, and then you use this as a back testing tool. Okay? I didn't do quarterly rebalancing, and I didn't do cumulative returns using the dividends to go back and plow back into the individual's shares. I'm actually doing that on another project of mine in real life, but you're on the right track. Okay? I just tried to make it simple. I mean, it was hard enough to program anyway. And then we did a 10-year. Okay? So the 10-year. What's the problem with the 10-year right now in history?
It's the highest it's ever been.
Exactly. So what's been happening over the last 10 years? It's only gone up, right? So I have no recession in my, so I really, you only have an optimistic performance. usually when you go back 10 years, it usually captures the tail end or some part of the recession. I mean, imagine if I was doing this 5 years ago. I would be able to test the portfolio, stress test the portfolio under not only a recession, but a growth peak.
Well, then could you just like do it 15 years?
Yeah. You would do 15 or 20.
20.
Yeah. If your stocks go back that far.
So if they don't, what do you have to do in the future?
What I usually do, if I don't have history for the individual stocks, what I'll do is I will run a correlation on that stock, on other stocks within the sector. So Apple, basically, if you're looking at Apple along with other, tech companies, Apple's like the bellwether. So a lot of the tech companies are tied to Apple, so they're highly correlated. So if I know what Apple did historically, and I know the correlation, I can basically fill in the history using Apple as basically the calculator for the other stock that doesn't have the history.
Sorry, what about like some of these new companies that are like let's say Uber, for example, like there's no one you could compare, there's hasn't been a business like that.
No, it's really hard.
So how would you even, couldn't do that? Because who would you compare it against? Snapchat, Facebook?
Yeah, but you could run the current correlation on Uber against other stocks that do have the history. And then basically you use the correlation coefficient to be able to calculate what the stock price would have been historically.
Okay.
Or what you can do is you can say, okay, Uber stock over X number of years that it's been around, has grown at, X percent, per year, per quarter, per month. And you basically can, do a constant, you do a discount factor, and you discount the share price back to where it would be if the growth rate trend was constant. That's another way of doing it.
So when you do this, does it affect like the companies that have like, that literally make no money, that are losing money every year, does it affect your, doesn't it make your thing look really ugly when you're trying to figure out?
Yeah, I try to use established companies that have been around at least 10 years. It makes it easier from a calculation standpoint. If you want to play in the small cap space and create a risky, high yielding portfolio, then that just means there's going to be more mathematical adjustments that we're going to have to make to be able to do back testing and do optimization. Okay. Did I run out of time? Yeah. Okay. So I'll continue to go with the worksheets, pull them up, take a look at them, start to get familiar with them. Okay. And then on Tuesday we'll come back. We'll